according to astrologers, that this year is going to be a strong, prosperous, and lucky year for almost all Chinese zodiac signs. And it'll be a good year for business and investing. But there's a caveat. This will only happen if you plan properly. One of the biggest challenges in 2019 was really the dominance of foreign funds flow in our market. And we need to adapt to this change. One of the ways we can do this is having an exposure in what we call strong, resilient, large cap index issues in your portfolio. This will help protect you in the downside, as well as give you the ability to take advantage of market recoveries, because these are the first issues that will bounce back. And there has really been a shift in the way people invest today.
I know we are besieged by negative news flow coming from recent natural disaster, so very close to us and affecting some of our brethren. Not to mention regulatory risk issues, and very recently, this invasion of a potentially threatening virus known as the coronavirus coming from China. That certainly has everyone worried. My role is to remind everyone that despite all this, the macro upside is still quite robust.
So if you were to ask me what are my favorite sectors for 2020, they would be the consumer sector, the banking sector, and the property sector. Okay, for the consumer sector, of course, it's because of the strong economic outlook that I feel in some ways would be consumer-driven. And, you know, since now we're all worried about regulatory risk, consumer companies are less vulnerable to them. So our best ideas would be URC, CNPF, and SSI. For the banks, okay, with the favorable economic growth outlook, we're anticipating faster loan growth. And as the government reduces the triple Rs, we believe this would mean lower funding costs for them, or at least benign funding costs. The negative, though, is last year they booked a lot of trading gains, and we're not anticipating any more trading gains this year. Our favorites would be Metrobank and Security Bank. For the properties, hopefully this year will be much better. So we expect demand to still be strong given lower rates and the strong economic outlook. But I think the other catalyst would be diminished POGO risk, because our government or the president has already said that China will not interfere with our POGO policy. And secondly, the revised IRR for REITs, or retail investment trusts, came out, which should enable our property companies to actually list REITs or REITs. And this will allow them to raise capital, which is really very exciting, no? This will allow them to unlock the value of the rental properties and help them finance their other projects. The key risk, of course, is, you know, if you think about it initially, medyo hindi naman yata vulnerable sa regulatory risk ang properties. But of course, with the Ayala land development, we don't know at this stage. So our top picks would be Ayala Land, Mega World, and Robinson's Land. Okay, so this is a summary of our top picks in our buy below prices. Now, some of our recommended stocks are trading at expensive or still expensive valuations. But we recommend that you wait for them to correct to our buy below prices before you start buying them. Because, you know, it's not a runaway market. The market is not very strong. So we believe that there will be opportunities for you to actually buy these stocks at more attractive valuations. So in summary, while our fundamentals are too robust to ignore, we are also facing certain issues that are hurting foreign investor sentiment, such as heightened regulatory, environmental uncertainties, and growing irrelevance of the Philippine market in the emerging market basket. We're confident that these issues will be resolved and continue to recommend investors to buy Philippine stocks. However, since we don't know when and at what level the Philippine market will bottom, we would like to stress the importance of risk management, which can be achieved through diversification and proper asset allocation, and of course, thinking long-term.
Now, what do I do in the Philippine condition? In the Philippine condition, I would only look for two types of trading opportunities. The first I would call looking for stocks and trying to buy them because they're strong and they've shown you trend resilience. What that means is you either have a strong upward moving situation or maybe gradually moving sideways. And what you want to do is buy it at the low end of the range. Okay? Because it may not fall as deep as what you think it may. They're called resilient stocks for a reason. It's because they're trying to resist falling down. And if you're trying to wonder why, it's really because of the advent of indexing, of which I think Dino presented and April talked about earlier. Because people who buy an index fund will automatically have that flow come into these stocks. That's the reason for why you're seeing that. So the other trading opportunity you'll get are from issues that have been, of course, have capsized because of regulatory risk or issues that could be caused by natural calamity. And because of that, you would see stocks like this go all the way back down quite heavily. So GT Cup, downtrending situation, but now all the way at the bottom end of the range. So this is called mean reversion if you take a trade like this. All it means is this is where the stock is going down and it's supposed to follow this angle, but now your stock is way down here. And the difference between where you are down here to where it should be is what you're going to try to take advantage of, a rally from here to this point here. So if you look back into your picture in GT Cap, the trade here for mean reversion, which means let it go back to where it should be, would be to buy it closer to the lower end of this range for a potential target closer to the high band of this, which is somewhere here or here. And you're going to get a lot of these types of opportunities into the market. This is the código here. I color-coded it for you. The green horizontal lines will show you all those index stocks that are resilient. Okay, generally holding sideways to up. And I put some resistance and support areas there so you can get a range of what the high band and low band of the ranges should be, so you can take that to your advantage. The blue-colored prices are issues that are currently in consolidation. It's very hard to trade those stocks. If you want to do that, remember again, low band, high band only. Don't anticipate anything out of the band. Okay? But if you're going for mean reversion, the orange ones, that means these are issues that have fallen down quite steeply already. And that you're just waiting for them to turn, and then it may make a counter move that may be give you a better opportunity than buying, of course, the more resilient stocks. So what is in return for that? Yes, you might have more upside, but it will generate more choppiness along the way. And I don't know if you guys can take the heat of that type of movement. So if you're, depending on your personality, if you're more long-term in your approach, I would suggest you go ahead and buy their more resilient stocks. I don't think you're going to anticipate a heart attack in moments from them. All right? Or you could try the ones in blue, but just make sure that if the lower ends break, you know what can happen. That can crack and that could still slide. So maybe put protective stops in there. If you are a trader, you probably want to look for mean reversions because this is where upsides become more pronounced for you. And if you buy them, you simply look at the last low it made and put a protective stop there, and you gun for the potential next resistance targets that you have. So why only index stocks in my list? I think Dino told you earlier, the reason that indexing becomes very important now is because fund flows goes there. When you have climates like this, that markets are still uneasy, the last thing and most dangerous place you want is to stay in a stock that is illiquid, stocks that don't have any value.
I think this year started off with weak market sentiments, and this was, of course, driven by another slew of issues. I think I want to remind everyone today that these occurrences will continue to create turbulences in the short term. But it also brings opportunities to generate higher returns. After all, you must remember that we make most of your money in bear markets. We just don't realize it at that